So thank you everyone for joining us on Sunday evening. Today we have with us a renowned person, Gautam Baid. He's a CFA and founder of Stellar Wealth Partners Private Limited, a SEBI-registered research analyst. So previously, Gautam has been a portfolio manager at Summit Global Investments, and he has also worked as a senior analyst at Citigroup across locations, US, Mumbai, and all. So he's popularly known by his international bestseller, The Joys of Compounding, and surely will be gaining so much of insight from the books and the experience of Gautam. Gautam, welcome.
Hey Prince, thanks for this.
Thank you. So Gautam, initially, I would be asking questions, and after some time, we'll allow speakers to ask questions from you.
Sure, sounds
Yeah,
good.
great. So, guys, the session would be targeted till 8 p.m. But in case if we have more questions, we can take additional 15 minutes for that. So, Gautam, very basic and initial question which I ask from all of our guests: how it started for you? I mean, what made you believe that you are made for investing and all? So, how you developed so much of passion for the investing and all?
Sure, so I've talked about this at multiple forums before, but I'll just quickly summarize the same here. So, like most investors typically enter the stock market, same was my story. I was attracted to the stock markets initially during the final euphoric phases of a bull market. In my case, it was the 2003 to 2007 bull market in India. I remember I'd invested in a mutual fund called Reliance Power Sector Mutual Fund in late 2007 and a stock named Ispat Steel in early 2008 because both power and steel were the hot and fancied sectors of the time. Now, recency and vividness biases are very powerful but highly costly behavioral mistakes. I'd simply extrapolated the recent price trends in those investments without paying any heed whatsoever to their valuations or underlying business models, and I ended up paying my tuition fees to the stock market. Both those investments crashed 70 to 80% within the first 12 to 18 months of my purchase, and it served a very useful lesson for the remaining part of my investing career that just don't chase stocks blindly out of recency bias and what has worked very well in the recent past. Always focus on the underlying business and focus on finding value, not on the stock price. So that was a very useful experience. Now, even though it was a big initial setback, my interest and curiosity about the Indian stock markets remained very high throughout the first 7 years of my professional investment banking career. And after working for 7 years in Citi and Deutsche, I finally quit that particular field and relocated to the US in 2015. I thought I'm a CFA charter holder, so I should be able to get a stock market job pretty easily. But I had a struggle of 1.5 years in the US, where I used to work for minimum wages at a hotel in San Francisco to sustain myself while I looked for a stock market job. Finally landed up with a very good job as a portfolio manager of global equity strategy with Summit Global Investments in Salt Lake City in the state of Utah, where I worked for 4.5 years. And I was tracking global stock markets as part of my role. And during the course of those 4.5 years, India as a stock market very clearly stood out to me in terms of the number of high growth opportunities it offered. So last year in July, I quit that job to set up my own India fund in the US. At the same time, I also set up a research analyst, SEBI-registered research analyst firm in India, and offered a small case offering for retail investors in the country. So that, in a brief, is the nutshell of my journey.
Right. So Gautam, I one of your previous session, I heard you say the supply of quality equity is low in India, right? So you have experience of US markets and other global markets, and additionally, India. If we talk about India, so what are the difference you see, and how one should go about analyzing the companies, and if say one has interest in investing in India as well as in US, so what difference you see, and what should be the ideal approach per se?
I think the single biggest differentiator is in the levels of disclosures and reporting and the levels of corporate governance. Those are generally not the issues which you face with many companies in America, but in India, you have to be very careful. You have to have a lot of experience in the Indian market to be able to understand which promoters are ethical, which ones are not. Because many of the time in a bull market, if you simply go by the reported numbers through the income statement or the P&L, then eventually later on in the subsequent bear market, you'll realize that all that was just misleading basically, because a lot of those books are basic books and accounts are basically fudged. So these are the things you have to keep in mind. If you Many people who experienced the 2017 bull market in India will recall, towards the end of 2017, we had a big bull run in many SME listed stocks. Many of them turned out to be fraudulent later in 2018-19, because many people were just focusing on the reported revenue and net profit growth without focusing on the working capital situation, the balance sheet situation, the receivable situation. But this is a common mistake which many new investors make. If they encounter a bull market early on, they focus on the P&L, but the experienced investors focus more on the balance sheet and the cash flow statement. But this comes only with experience after having gone through a full-fledged bear market. And for people who saw bear market in India from January 2018 to March 2020, they'll recall that the small cap index that time 65% from the peak, and the mid cap index 55% from the peak. Individual stocks in small cap and mid cap space that time fell 70 to 80% on average across the board. So that was the longest ever bear market which I faced in my investing journey so far of the last 15 years. But it taught very, very valuable lessons for the remaining part of my investing lifetime.
All right. So, Gautam, when it comes to investing, when we start, we have a different view, and I mean the buy sell thing. And as we evolve, see some certain cycles in the market, we evolve and form a process, right? So, what is core to your investing? I mean, if we want to know about the investing frame, what matrices or what data points you look for? What are the screeners you run before zeroing in on any idea? So, how you go about it?
So if you want to understand how do I go about idea generation and what is my stock screening process, so the entire process has been buttoned down in place. It's a very structured process. So starting from the Bombay Stock Exchange corporate announcements. So every single day, I diligently review all of the corporate announcements on the Bombay Stock Exchange website. For many people, it's a very tedious exercise, but for me, it is like an intellectual treasure hunt wherein I may strike gold anytime. And every day I'm letting serendipity and good luck find me and my investors. So go through press releases, investor presentations, mergers and acquisition deal, joint venture, partnership agreements. When I'm evaluating quarterly results, I'm on the lookout for what I call breakout earnings. So what are breakout earnings? It means companies which are reporting a revenue growth of more than 50 to 100% year on year, and earnings per share growth of more than 100 to 200% year on year. And in such cases, the stock market is generally slightly slow to adjust the stock price to the right higher level immediately after earnings. So even if you buy such stocks 5-10% higher the next morning after earnings, you still end up making pretty good money. And this phenomenon in the stock market is known as PEAD, post earnings announcement drift. I also go through conference calls of companies that I'm tracking on Trendline, Alpha Street, Research Bytes, company website, investor relations section. One peculiar problem with many Indian companies is that the promoters tend to be overly bullish during good times and highly pessimistic during the bearish times. So it's very important to corroborate and cross check what what they are saying with what their global peers are saying. So I do that as well. I also go through the management interviews in print and digital media. For screening tools, I use Tijori Finance to track commodity and chemical prices and to also conduct a reverse discounted free cash flow operation. And on screener.in, which is a very popular screening website in India, I look for companies which have either completed a very big capex or are on the verge of completing a very big capex. I also look for stocks which are hitting a 52-week high or an all-time high or a post-IPO new high. Post-IPO new high simply refers to situations where after a long time consolidation post the IPO listing day high, the stock breaks out to a new high. So generally that coincides with something important taking place in that company or industry. And here I would like to emphasize that time frame and context matters the most when you're evaluating price action to screen ideas in the stock market. So immediately after the bear market crash, look for stocks which are hitting a 3-month or a 6-month high. During a bull market, when you have hundreds of stocks hitting 52-week highs every day, look for stocks which are hitting a multi-year high. And in a sideways, non-trending or range-bound market, look for stocks which are breaking out to fresh 52-week highs. The whole idea behind this exercise is to find pockets of relative strength and to respect the collective wisdom of the market to guide you in the right direction as to which sectors are experiencing tailwinds. I also study equity research reports written by brokers whose quality of content is pretty good. They include Ambit, ICICI Securities, Spark Capital, India Infoline, Nirmal Bank, and Axis. I also read annual reports and credit rating reports of companies that I'm tracking. DRHPs and QIP offering documents are a very good resource for getting detailed information about the underlying industry of a particular company that you're studying. So, as an example, if you want to understand the dynamics of the music licensing industry in India, you can go through the recent QIP offering document of a company named Sarigama Limited. Investor letters written by fund managers whose investment philosophy you admire and respect are another very good source for screening ideas and idea generation. I like to read the letters written by Solidarity, Sage One, Equirus, even 2.2 Capital letters are pretty good. For investing conclaves, I attend the conclaves by Tamil Nadu Investor Association, TIA, and India Investing Conclaves. And for webinars, I like going through the webinars organized by SOIC, School of Intrinsic Compounding. A less talked about but very useful resource for idea generation is Fund Managers Top 5 Holdings from PMS Bazaar website. The sign in on the website is free, and once you have logged in, you can actually have a look at the top 5 stock holdings of fund managers in India whose investment philosophy you admire and respect. I also review bulk deals, block deals, and insider bank data on a daily basis. StockEdge mobile app does a very good job at this. And I also review the 52-week high volume list on a daily basis, because if any company's stock is experiencing a 52-week high trading volume on a particular day, it generally coincides with something important taking place in that company or in its underlying industry. For magazines, I read Fortune India, Forbes India, and Outlook Business. And for newspapers, I go through the Economic Times. And as far as industry specific websites go, I go through Contract Pharma for pharmaceuticals and healthcare. I go through Chemical Weekly for chemical, Steel Mint for steel, Platts.com for commodities tracking. I also engage in daily discussions with my peers and colleagues in the industry. And I'm also on the lookout for views of the leading analysts of individual sectors. So, as an example, in the Indian healthcare space, Aditya Khemka and Sajal Kapoor are pretty well known in the investing circles for their views. And whenever they have a Twitter space or a webinar or an interview session, I try to learn from them, because this practice of learning from the leading analysts of individual sectors greatly helps in accelerating the learning curve. Finally, we have social media platforms like Twitter, WhatsApp groups, and Telegram channels, and online forums like Value Picker and Multiply. Now, if you go through such an extensive list of resources on a daily basis for the remaining part of your investing career, it's very difficult not to be simply flooded with good opportunities all the time, be it a bull market or a bear market or a sideways market. In life, business, relationships, or investing, nothing will work unless you do. And there is no reason for anyone to settle for an inferior track record in a marketplace like India, which is filled with stock opportunities with asymmetric risk reward. So, this is a gist of my idea generation and stock screening process, Prince.
Right, Gautam, very great. So, Gautam, when we go through so much of tools and so much of data, or we get so much of input feeds from different learned investors, and so how you segregate the idea that this is the one I should focus more, and this is one. I mean, how you find out the opportunity cost and everything related to that? I mean,
The first and foremost thing is to focus on what is known as the circle of competence. Just focus on things that you can understand well. That itself will filter out most of the names that you come across. Because, see, today we are facing the problem not of lack of information, but that of information overload. We are parts of many WhatsApp groups, Telegram channels, we are on Twitter. So there is no shortage of bombardment of ideas thrown at you from various sources on a daily basis. But as long as you are disciplined enough to stick to your circle of competence and focus only on things that you can understand, on industries that you can understand, that greatly helps cut down the noise. Because if you keep chasing the stock price which are stocks of businesses that are just rising without understanding them fundamentally in the first place, then we'll end up selling them at the first sign of market correction in a state of panic. So very important to be disciplined. In the short run, the aggressive may win in the market, but over the long run, it is the disciplined who win. This is the single biggest learning from all the great investors in history. It's all about discipline, patience, and behavior.
So I mean, I heard you say like short-term paranoid and long-term optimist. So are you referring to that thing?
That, in a nutshell, yes. Basically, you have to be a long term optimist on the progress of humanity and mankind. But in the short run, you have to be cognizant of the fact that things can and will inevitably go wrong, and from sources which you can never imagine. And that is where risk management comes into the picture. You cannot concentrate heavily into one single. You cannot have all your eggs in one basket, as in the entire portfolio in one single sector, or the entire portfolio in just one or two stocks. You have to be sufficiently diversified. This is the single biggest learning I've got from last 15 years of investing in India, that this crazy things just take place from anywhere and just happen randomly out of nowhere. So you'll have regulatory risk, you'll have industry risk, you'll have government risk, you'll have exchange related risk. Like in the 2018-19 bear market, I remember exchanges came out with what is known as ASM, additional surveillance mechanism, because of which, and then SEBI also came out with the mutual fund reclassification. There's regulatory risk plus exchange rate, that exchanges risk. That time, just these two risks were enough to kill the small cap and mid cap space for 2 years. So risk can come from any angle which you cannot even think about. So it's very important to be sufficiently diversified, and also to be very cognizant of reality. See, the great investors in history accept reality for what it is, not for what they hope for it to be, want it to be, or wish for it to be. So you have to be a realist. It's not the optimists or the pessimists who make or lose money in the stock market. It is the realistic people, the realists, who actually make money in the stock market. So you have to be an ardent student of financial market history, and you have to accept reality for what it is.
Right. So there is one question from Majid Khan. He's asking, does long-term investing work nowadays? If we don't book profit, we see going the company into stage for years. So what are your views on that?
Very simple. So basically, you buy on dips in long-term secular domestic consumption stories, but you keep booking profits in the cyclicals and commodities. You have to be very clear the kind of investment position you're entering into, and also in the secular growth domestic consumption opportunities. Sometimes they enter into simply bubble valuations. So, and like I mentioned in my previous interviews, that the supply of high quality long-term secular growth opportunities in India is very, very limited. So the moment those stocks hit the market through a IPO listing, generally they list at very expensive valuations and become even more expensive from there. So you have to be cognizant of valuations at the same time. So ideally, if you can get into these high quality secular growth companies at 20-30 p multiple, and then sit patiently on them, you have to at the same time exit them when they enter bubble valuation territory, because we have seen a few stocks which are right, like I don't want to name those stocks right now, but we do know of a few consumption stocks in India which are basically now trading at 150 to 200 p multiples. So you have to be very cognizant of bubble valuations, because when the bubble eventually bursts, that is when you can really incur permanent loss of capital. So you have to be cognizant of valuations. There is no getting around that.
Right. So there is one question from Akshay Bharde. So he's asking for you to say that business is not growing as per your expectations. How many quarters do you wait before cutting your losses?
Generally 4 quarters at most, 1 year at most. If the businesses, and more than anything else, focus on the execution of the management. If they're not able to execute over one full year, then generally I exit the position even at a loss if required, and move money into a new position. But that's the maximum I would wait for a business to management to execute.
Right. So when it comes to selling, we need to be very disciplined. But selling again comes with a regret. So what's exactly your thought process when it comes to selling?
So these high quality secular growth stocks in India, which have a long runway for growth, their valuations are very, very sensitive to earnings growth deceleration. So what does that mean? So basically, if you buy a high growth stock in India at suppose 70 TP multiple, as long as the growth rate remains very high, the price to earning multiple does not derate very fast. In fact, it keeps re-rating forward, and it keeps getting more and more expensive. But the moment, but if the deceleration in growth rate is slow and orderly, then the price to earning multiple does not collapse very fast. But if you have a situation where a company is growing at 35-40% for the last few years, and suddenly the earnings growth rate collapses to 10-15%, in that case the P derating becomes very, very sharp. So it's all about the rate of change. If the rate of change in earnings deceleration is slow and orderly, then the P ratio will come down slowly over time and you'll get a chance to exit at a good price. But if the slowdown in earnings growth is very, very sharp, then you'll experience a very then you will experience a complete collapse of the P multiple. So you have to differentiate between the two aspects.
Right. So another question is from Gaurav. He's asking, an individual investor with a limited small circle of competence, say finance and retail sector, should he invest only on those sectors, or how he should approach his investing?
You can start with those two sectors first and then keep reading, studying different industries to keep expanding his circle of competence. I think generally, as a thumb rule, you should at least have 5 industries and more in your portfolio, not just 2. Ideally, you should have five or more.
Right. So there is one from Snegendu. He's asking, is it right time to US tech stock? And he's also asking about the future potential of IT sector from current point. Current point, yeah.
I think both are great value buys. Both the Indian IT services industry and as well as the US technology industry. Now is, I think, the right time to start putting capital to work, because if you don't put money to work now, after the stock prices in US, of many big large cap, mega cap stocks have fallen 40-50%, then then I doubt they'll be able to enter later at a higher level. So this is the time to actually start putting money to work, because these are very high quality businesses, and you're actually getting these high quality businesses finally at a discounted price. So yes, value has definitely emerged in US tech and Indian IT services industry as well.
Right. So, Gautam, like the micro and small cap space has limited information, and there are chances like we end up wrong in that. So, for that, we need scuttlebutt and all. So, what are the additional data points you consider while analyzing that space?
Well, in terms of additional data points, basically, I think the past, these micro caps which you're talking about generally have a very limited track record of performance and business execution. So it's more a leap of faith on the promoter. In small companies, it's all about the P, the promoter entrepreneur. Basically, you're betting on the promoter. You look at his background. Ideally, if you can get a situation where you have a micro cap company in which the top management is from a previously big established company, which with a proven track record, generally the base rates of success are better in those cases. Otherwise, when you're investing in a particular micro cap from a particular industry, just try to ensure that at least that industry is experiencing a tailwind, because that is what will help you give a boost to your investment prospects. You need both industry tailwind as well as some prior experience of the promoter in that particular industry if possible. But never bet on just single or one or two micro caps. Always play it through a basket, because these micro caps are very, very risky.
Right. So there is one question from Lata. She's asking, according to you, what would be the highest number of stocks you hold at any given point, and do you believe in concentrated or diversified portfolio?
So, as per a study published in the international bestseller, A Random Walk on Wall Street, it was shown that as the number of stocks in a portfolio reaches 25 to 30 names, the incremental volatility reducing benefits of diversification reach near zero. So 20 to 30 stocks is the sweet spot for an active investor seeking to outperform the market. I think beyond 30 stocks, you don't enjoy any benefits of diversification after that. So that's the maximum number of stocks that I would recommend to hold at any point of time.
And she's also asking about concentrated portfolio and diverse. I mean, what is the diversification as per you?
So, in as far as I'm concerned, I size individual positions in my portfolio according to my evaluation of potential risk, with the highest positions having the least likelihood of permanent loss of capital, coupled with above average return potential. I size in new positions with a minimum weighting of 3 to 5%, and then subsequently average upwards on management execution. If the management executes above my expectation, then I don't mind averaging upwards as well. And individual position sizing is important not only for its impact on overall portfolio performance, but also for one's mental peace of mind. If a single position becomes a discomfortingly large percentage of my portfolio by value, then I sell down to my sleeping point. And one should have higher weights in businesses with disciplined capital allocators, high longevity, and solid growth prospects. As Mae West very aptly said, too much of a good thing can be wonderful. So I think you would ideally want to be concentrated yet sufficiently diversified enough so that no single position can actually wipe you out. So in the initial years, when your capital is smaller size, generally most investors are very concentrated. But once you have achieved financial independence and become rich, that is when you basically become more diversified. So it's, I think, also a function of your risk tolerance as well, how much concentrated versus diversified you want to be.
Right. So Mania is asking like, how is the idea of investing through ETFs?
It's a good idea. I think it's a low cost option to gain access to the market. You can start with, and like first you start off with index funds, then you go to actively managed mutual funds, then you can go through a small case, and then you can go through a PMS, and then you can eventually do direct stock investing yourself. But yes, the ETFs is definitely a low cost, cheap way to access this market. It's not a bad option.
Right. So you talked about the basket approach and company specific. So which one you prefer, top down approach or bottoms up, or it depends? Like it's a combination which you use.
Combination is ideal. Top down will help you identify companies with sectoral tailwinds, and bottom up analysis will help you identify asymmetric risk reward. So I'll give a good example here. So top down we know right now that because of the changes in RBI regulations for microfinance companies, the NBFC microfinance industry in India is experiencing a big tailwind. At the same time, we also know that the overall microfinance industry in India is also doing very, very well right now. So that's the top down view. And bottom up, if you go bottom up now, you'll see that there are a few companies which are going to engage in a reverse merger. So you have a holding company, and then you have the main microfinance company. So the holding company will actually merge with the macrofinance company. There you have some merger arbitrage opportunities in that particular space. There are two live merger arbitrage opportunities in the macrofinance industry as we speak right now. So you can definitely do that bottom up analysis there. So top down for sector tailwind and bottom up for finding asymmetric risk reward bets. And the more asymmetric the risk reward, the higher your allocation.
Right. So Ravindra Surana is asking like active portfolio versus passive portfolio. What is the sweet spot with respect to churning or staying invested? Should we time cycle or reduce cost value averaging?
I think if you can time the cycles, nothing like it, that will help you generate very high returns over time. But most investors find it very, very difficult to do so. I think, also you talked about how long to stay invested for. I think in my investing journey, I've stayed invested almost all throughout the last 15 years. I've hardly taken cash calls based on macro factors. I've taken the falls as well as the ups. So no pain, no gain. So basically, I don't really believe in timing the market. I think time in the market is much, much more important. And as for the sweet spot between passive versus active, I think again depends on an individual comfort level. I try to be an active investor from the very start, but it definitely is a time consuming activity. You have to devote a lot of time to this particular business. It's a 24/7 activity. You cannot just do the tracking and the monitoring on the weekends. It doesn't work like that. You have to devote some time every day to this.
All right. So Ravi and Kanan, if you have any questions, you can ask after this question. So investing journal is very important, right? So what all we need to record? Is there any set template, or what should be ideal way of recording the, I mean, is investing thought process and ideas before buy and sell?
I think an investment journal is extremely important. I've been maintaining one since late 2014, and I consider that journal to be one of the best value investments I've ever made. And that journal basically can contain whatever buy or sell decision you're doing, your thought process at the time of making that buy or sell decision. And you can also record very thoughtful and insightful blog post or white papers or other annual reports or any industry pieces, whatever you're coming across, any YouTube video which is very informative. You can actually keep a full running record of things that you're learning along the way. In fact, I've been, now I've exhausted many investment journals over the last 6-7 years. In particular, since middle of 2018, my writing frequency in my journal really, really accelerated a lot because that is when the bear market in India really gained steam, and that is when the maximum amount of learnings in my journey actually took place between 2018 and 2020 during that bear market. So the journal has been very, very helpful, and I think it's a very good habit because it helps you remain objective and to learn from your mistakes. Because many times what will happen is we confuse the outcome with a good, we confuse a good outcome with a good process. But when you maintain a journal, you will realize that in majority of the cases, the good outcome was primarily because of good luck. It was not because of some intelligent thinking. And this is what will help you take away the right lessons from the investing outcomes. So highly recommend everyone to keep an investing journal.
Right, thanks. One more question, this is from Pooja. If someone is patiently waiting for markets to fall so that she can invest money in bulk in mutual fund, but market goes 52-week high, how do you think she should take next steps? I know waiting for markets to fall to put money is wrong decision, and we should do SIP only. But what now?
Simply do SIP. I think patience is the biggest equalizer of cycles in financial markets. You just need to be patient with good stocks over the long run, and eventually you'll make good money. Because since 1990, the bull run in India has been in force for the last 30 years, since the 1991 economic reforms, and ever since then, after every 1,000 point rise in the Sensex, people say that now the stock market is fully valued, it's overvalued. How much higher can it go? The Sensex will eventually go to 1 lakh, then to 2 lakh, then to 3 lakh, then to 4 lakh, and then five, possibly even 5 lakh in a lifetime. It will happen gradually. It will not be a smooth journey straight upwards. It will have its ups and downs. But in a country which is having real GDP growth of 6-7% and inflation of 5-6%, when you have nominal GDP growth in double digits, you can easily expect the stock markets to replicate that nominal GDP growth rate over the long run. So eventually we'll scale much higher levels. But I think rather than trying to time the tops and bottoms, just be disciplined and keep doing SIP every month.
Right. So Ravi, you want to go next?
Sure. Hi, Gautam. Great to connect our spaces. I'll ask one specific question on sector. Say, which are the sector you're bullish when you're seeing market in the US? Because sometimes it happens that we take a cues from from the developed markets, and then those sectors, after some point of time, start working in India as well. And any sectors where you are very bullish in the Indian market. Apart from that, off late last few months, there has been lots of bullishness on the PSU side. So any take you have on those sector, PSU banks or defense, which are being the most sought after in the recent past. And
I
one
think,
general,
yeah.
how you cut about noise which comes from the media side, like you talked about reading about so much of journalists and research report, but then there are lots of recommendation and news flow which comes from media and WhatsApp. How you cut that noise?
I just try to keep it structured. I am not part of many WhatsApp groups or many Telegram channels, barely 2 or 3 each. So that greatly helps cut down the noise. I do not watch any business television channel at all. At most, I just go through the management interviews on that particular, channel's YouTube channel later on at my own pace. That greatly helps put some, have some, sanity among all the noise. As far as defense and PSUs are concerned, now my only issue there is that the promoter or the owner is the government, and the government does not really work for the minority shareholders. They work for societal good. So the incentives are not really aligned with the minority shareholders there. But yes, because of indigenization of production in defense and because of the sectoral upcycle in banking in general, we have seen very handsome gains being made in defense and PSU banks in the last few months. I think they are very good trading bets, but that is but we should all be really cognizant of the fact that you can trade in and out of such names, make some good money, but they're not secular, buy and hold and forget type names. You just have to keep booking profits whenever you get some, whenever you get the valuation re-rating from half price to book to 1 to 1.5 price to book in these PSU banks. I think that is a good time to at least start taking some profits off the table. And in terms of sectoral preference, I'm very, very bullish on three industries in particular. Number one, domestic banking industry. Number two, auto and auto ancillary, because I think with the semiconductor situation gradually improving, they'll also get back to speed. And number three, domestic manufacturing. After a long, long time, because of the PLI provision linked incentive scheme. There's a big surge in domestic manufacturing which is taking place, further aided by China plus one and Europe plus one. I think these three industries, domestic tenders, auto and auto ancillaries, and domestic manufacturing. I think these three industries will do very well over the next 2 3 years.
Great. So Kanan, you can unmute and ask quickly.
Yeah. Hi, Gautam sir. Great fan of your work, of your book, and your humility. So, I have just two questions which come from your book only. So, first one is on special situations. So, I wanted to understand this thing like in your Elon Markets episode also with Vivek sir. I was listening to it. So you were talking about the Aarti Industries demerger, right? So where
Mhm.
does the mispricing happen? Does it happen in the script before the merger, or it happens before the demerger or after the resulting companies listed?
So there are, I think the really big money in demergers is made in when there is something called force selling. So when does force selling take place? Force selling takes place in two kinds of demergers. One is a market cap demerger, one is a sectoral demerger. So let me explain both of these in detail. Market cap demerger. So when Aarti Surfactants demerged out of Aarti Industries, Aarti Surfactants was a tiny macro cap, and because Aarti Industries, the parent company, had institutional shareholding, mutual funds and other fund managers overseas held that stock of Aarti Industries. When they received shares of this microcap Aarti Surfactants, they wanted to have nothing to do with that particular microcap. They just dumping that share in the open market at whatever price they would get. That's why the stock of Aarti Surfactants fell 40-50% after the listing. So that was a case of a market cap demerger. Now, what is a central demerger? Let's take the same example of Aarti Industries, which is demerging its pharmaceutical business very soon. Now, even though the pharma business will not be a micro cap, but because Aarti Industries is a chemical company, so all the chemicals mutual funds or the chemical dedicated funds and investors, when they receive shares of this pharma company in their portfolios, they have to engage in forced selling of this particular stock on the market, and you may again end up with a good opportunity for getting a good quality business at a very cheap valuation. Because when you get forced selling, then the prices become really depressed in a very short span of time. So market cap demerger as well as sector demerger. Just keep these 2 points in mind.
Got it. Got it. So I just had a follow-up question on this only. So in the sectoral demerger that we are talking about, this happens after the listing of the resulting company takes place, right?
Correct.
Okay, so but if we compare this with Jubilant Ingrevia, I think it started with somewhere around 220, 240 odd pricing, and it kept on increasing from there only till 800 odd levels, but it's down for a different reason now. But we didn't get to see any, downfall after the demerger took place. So I was just confused over there, and I couldn't find anything around it on the internet.
Jubilant Ingrevia was demerged out of Jubilant Life Sciences, and Jubilant Ingrevia fell 40% after listing.
I think Gautam, we lost you. I cannot hear you. Is the same with Ravi and Kanan?
Is
Yeah,
my
yeah,
voice? Is
Yeah,
my voice coming?
we didn't heard about Ingravia
Ye-
USA.
yeah. Now
Okay.
we can listen to you. Yeah.
Yes, I was saying that if you look at this operation of Jubilant Ingrevia, after it got demerged from Jubilant Life Sciences, Jubilant Ingrevia fell 40% after listing, and then from there it rose 200% in 6 months.
Okay, got it. Then I'll just check my facts once again. Thank you so much. I'll just take one more question. Really nice. I just take one more question. You were talking about techno fundamental analysis in your book, right?
Mhm.
And there you were talking about Balrampur Chini and one other example of the sugar industry. There you were talking about that the company with bad ROC might perform better in a cycle where a particular sector is doing good, right? So how do we analyze that that sector is going to do good? One was the example of that electrodes company, I think, which was I can't recall exactly. There was some blockage in China and Graphite India and the other one, HEG. So
Right.
how do we identify apart from this fundamental factor that China is closing down its stuff, and then it will benefit the Indian markets? Is there any way that we can look certain things on charts that this particular sector is going to do good, and which all indicators can help us if at all?
The most simple way to do this is the market itself will tell you where to look for, because when you go, if you simply have a simple screen of 52 highs on a daily basis, if you just do a simple industry classification, if a large number of stocks from a single industry are making 52 highs suddenly after a long time, then there is something fundamental changing in that particular industry. For example, when you saw this 1 month ago, when you saw on a daily basis many PSU banks hitting 53 highs every day together at the same time, that would clearly tell you that the forces of the industry are running around. Same thing with the defense companies. So if you simply do this daily screening, then you can identify very good opportunities ahead of the majority of the stock market participants.
Really helpful, really helpful. Really glad you took my questions very nicely. Thank you,
Thank
Gautam.
you. Thank you, Khan. So there is one question from Majid Khan. Your views on specialty chemical sector like import substitution theme.
Very, very bullish. I think, like I mentioned previously, also China was one plus one. I think has lent Euro plus one has lent further credence to the story. I think that with these companies have a long runway for growth, and it is very evident the size of the capex plans being announced by the specialty chemical makers. You look at the kind of size of the capex which are with the nitrite or an SRF or North Industries doing. And generally, promoters put out such large capexes only when they are very bullish about the future of the industry. So long term, the prospects look pretty good.
Right. So there is one question from Adi. He's asking, please share some examples of growth or value traps.
Let me share the growth stocks everyone is being aware of. Let me give a good example of what is not a value trap. Let's look at when you try to buy a cheaply valued stock of a business from a dying industry or an industry in decline. That's a good example of a value trap. So print newspapers, for example, for many years, as the world transitions to digital, many of these print newspaper stocks in India have looked cheap and they keep getting more expensive over time. Why? Because the denominator, which is the earnings in the P ratio, the earnings keep on falling. So the stocks which look optically cheap actually turn out to be pretty expensive. So that's an example of value trap number one. Number two, if the terminal value of a particular industry or business is getting is at the risk of getting wiped out, then you can again get caught in a value trap. So let's take an example of the battery manufacturers in India. So we know that the battery cost in electric vehicles are the future. We know that battery cost is the biggest cost in an electric vehicle. If the auto OEMs start manufacturing batteries in-house, because batteries are the most expensive component for an electric vehicle, then this listed battery manufacturers, like Side they will also turn out to be value traps. So focus on terminal value. Is the terminal value getting destroyed or is it getting enhanced? That simple exercise can help you identify growth companies as well as value traps.
Right. So there is one question from Sam Vardhan. He's asking thank you for the amazing book, and he's asking when you met Mohanish Pabrai. So what kind of conversation you had with him?
Very honest, when I bid for charity like Monish Pabra in 2018, the only objective was to personally meet him and thank him, because two words mentioned by him in one of his previous presentations completely transformed my thinking process. Those two words were be unreasonable. What does that mean? You have to set a very, very high entry bar for any incoming stock or investment opportunity into your portfolio. Basically, do not add anything to your business, stock portfolio, or life in general unless it makes you better overall. So you have to be very unreasonable. Rather than looking for many mediocre or average opportunities, only great or very, very strong opportunities. So those two words had a big influence on my investing performance later on. So I just had met him to personally thank him.
All right. So Gautam, there is some issue on the voice. Some attendees are saying the voice is breaking. So please check with your connection. So yeah, you are audible to me, but there are some lags in between. So let's move on to next question. Next question is from yeah. So it's from again Ravindra. He's asking asset allocation about commodities and stocks. How you should we allocate capital? Physical gold. Silver versus ETFs or sovereign bonds?
Well, I'm a 100% equity has already advice on asset allocation. I think a financial planner will be much better equipped to answer that particular question. As far as I'm concerned, I think bulk of my personal liquid net worth is invested in the stocks of my India fund in the US, along with my home in Atlanta, which I plan to purchase next year. So basically, I'll have a house, I'll have my India equity fund allocation, and money in my checking account in the US, which is more than sufficient to take care of the next 5 years of living expenses. That's basically broadly my personal asset allocation. No, I have no gold, no silver. The only gold exposure which I have is in the form of some jewelry for my wife. That's it.
So there is one question from Karan. He is asking, manufacturing sector is one, but which other sectors can be more fruitful except discretionary?
I think financialization of savings is a very, very good sector to look at for the next 10 years. I'll tell you why. Because if you look at the history of the major stock market in the world, you look at US, Japan, and China, the fastest pace of wealth creation in those countries took place when those nations went from 2.5 trillion GDP to 5 trillion of GDP. And why did that happen? It's because when a nation transitions from a low income per capita country to a middle income per capita country, the basic spending on items like food does not go up much, but this spending on branded discretionary consumption and financialization of savings, these two categories explode. This phenomenon is already taking place in the Indian economy, the Indian stock market. Let me demonstrate. So today, India is at $3.3 trillion of GDP. But what happened as India went from 2.5 trillion to 3.3 trillion? 3 years ago, we had 3.5 crore demat accounts in India. Today, we are at 10.5 crore demat accounts. There is a 200% explosion in the number of demat accounts in India. So financialization of savings phenomena is already playing out. And this is just the beginning. Over the next 10, 15, 20 years, as more and more people get ingrained into the equity culture, there may come a time when the monthly SIP inflows may go from the current 10,000 crores per month to as much as 25 to 30,000 crores per month. Eventually, these big numbers will take place. We just need to focus on the long-term direction, and the long-term direction is clearly upwards.
Right. So there is an interesting question from Ehsan Ahmed. He's asking how you view the institutional favorite stocks like Divi's, Gland Pharma, Nykaa after the current sell-off. How do you view these companies at this moment? Another question is how to see trade invest in the stocks where lock-in period ends and when to enter in the stocks.
I think in the fundamentals, let me answer the second part first about the lock-in expiry happening. So generally that leads to some short-term selling from the institutional investors. And businesses of good quality, you may get a good entry point. But again, most of these new age technology businesses do not have any proven path or any clearly defined pathway to profitability. So I would be very careful, but definitely after this big fall, some value starting to emerge in some of the managed ones. I do not have any exposure to any of them at the moment, but this is definitely a time to start analyzing and studying them. As far as regards the first part of your question, DVs, Nykaa, Gland Pharma, etc. I think just analyze each company on its individual merits. If the long-term prospects still remain very good, and put money, but if you are not comfortable with valuation still, or the long-term prospects look very difficult, then simply avoid.
One question is from Raj Hariram. Did you give more importance to technicals before buying a business?
No, I think I give more importance to technicals when I'm trying to exit a particular business, especially cyclical and commodities. Why? So, practice which I've implemented in my personal trading commodities cyclicals is keep a simple trailing stop loss of 15% from the most recent peak. Sometimes these cyclical bets or commodity bets can reach bubble valuations or give you extraordinary gains in a short span of time. You have to be disciplined enough to preserve a lot of your gains. So there are different ways to do this. Either 15-20% trailing stop loss from the most recent peak price, or you can use a simple moving average, like the break of a 21 day moving average or a 50-day moving average to just preserve a lot of your gains. So you can use a moving average, or you can use a simple trailing stop loss from the recent peak price.
All right. So there is one question from Varun. If anyone has exposure to precious metal prospecting companies, which move from prospecting to mining, highly niche space. How you, suggest on this space?
I don't track that space at all, so I don't have any inputs on that particular question.
Okay, so one is how will you differentiate earnings peak versus earning is still there and we can stay in the stock?
This is a good question actually. So earnings peak, and there's also a concept called over earning or earnings peak. Basically, this takes place a lot in cyclical businesses which are in the middle of a big industry upcycle. We basically end up extrapolating the recent very high margins into infinity. That is when we can a big permanent loss of capital. So very important to differentiate cyclical businesses from secular growth businesses. Like for example, wedding retail, footwear retail, these are more secular growth in nature. But a lot of these auto ancillary, cement, or these steel companies, these are cyclical in nature. So just open screener.in, look at the historical margin profile. That will give you a clear idea of where you stand in the current industry cycle. Because if you're operating at really peak margins, that is the time to start getting cautious and start making use of these trailing stop losses or break of a moving average to preserve your gains.
Right. So Lata ma'am has another question. She is asking views on hotel and reality sectors for next 2 years.
I think the hotel industry in India is got a very bright future for the next 1 year, definitely. Especially with India being the host of the G20 meet summit, I think business hotels are really, really well. And as even real estate industry people are giving very bullish signals for the next 2 years. I would prefer to play the real estate upcycle through building material companies rather than the real estate developers. I don't really understand the accounting of many of these real estate companies in India, but I do like to have exposure to the building material space. Like for example, paint companies or pipe companies or CVPC players. Basically, building materials is a better way to play the real estate upcycle.
Right. So hey Krish is asking your view on oleochemical industry and what is the addressable market if you are aware of.
Well, we do have exposure to an oleochemicals player through a small case list of stocks, and even I've personally invested in one oleochemical player. I think the long-term trends look pretty promising, but let's be cognizant of the fact that the listed players in this space do experience a lot of margin volatility from time to time. So that is one thing to keep in mind, that the returns in this particular sector will be a bit lumpy and volatile as well. So it won't be a smooth journey up and upwards. We'll have some sharp corrections along the way.
Right. So Momentum Trader is asking what is the scope of dividend reinvestment plan on high dividend yield stocks for long term?
Dividend reinvestment plans are a very good way to have compounding on steroids. I think many of us, we treat the dividend income as free money or house money, and we tend to spend that money away. But the really disciplined investors actually keep reinvesting back all the dividends back into their portfolio stocks. So that's what I do with my India fund as well. Whenever any company declares a dividend, I simply just reinvest that dividend back into the overall portfolio. That's actually a very good way to boost your overall long-term returns.
Right. So another question is, did you think high liquidity in a stock is a issue for holding and staying with the business? I mean, high public holding.
Don't public shareholding. I think just don't worry too much about the liquidity of a stock. Focus on being right about the business. If even if you buy a liquid stock in the beginning in the business, as management executes and earnings flow in, and more investors come in, eventually the liquidity and trading volume will go up, and so liquidity eventually won't be a problem. As far as high public shareholding is concerned, in many stocks we've observed this pattern that if the the retail investor shareholding is going up, while the institutional shareholding is going down, generally there's kind of what is known as distribution. And that is generally around the time when the stock price experiences a medium term peak. So good to be aware of such shareholding patterns. We have seen this in many retail investor favorite stocks in the last 2 years, where the retail public holding was going up, while the FI and domestic mutual fund holding was coming down.
All right. So, guys, if you're liking the space, do check out our handles. And surely I would vouch for the book. I have read myself. That is a great book, The Joys of Compounding. That has a learning from various learned people, and you will surely enjoy. And that's great work by Gautam, sir. Thank you for that. And, sir, there is one question from Shriram Sridhar. Companies exposed to foreign currency risk, how do they enter into currency swaps when both parties have the same opinion on currency depreciation?
I'm not too sure about the answer to that question. Sorry.
Okay, so one question is on view on mid cap IT at 52-week lows.
Bullish. I think in terms of disclosure standards and cash flow profile, when you're in IT services industry, companies are very, very good. And this we have seen this cycle again. This is where it pays to be a student of history. This we saw the same industry down cycle in 2016 when many of these IT services industry stocks were at hitting 50-week lows and were available at single-digit multiples. I think eventually, we have got to around very good valuations of many mid-cap IT stocks, and this is a good time to start building a basket of the good opportunities there. But only for the long term. In the short term, I think they'll still face headwinds. But this is an industry in which you should not mind averaging on declining stock prices. So because the long-term fundamentals of this industry is pretty good.
So there is another interesting question like how will you play HCL Tech since HCL has ER&D division instead pure play ERD services companies like Tata Elxsi, KPIT, LTTS. So ERD companies are not getting high valuation, HCL not getting the normal valuation also.
Yeah, HCL is not getting the normal valuation because except for their fast-growing ER&D business division, which is a very small percentage of overall revenue, the rest of the business is not doing that well. So the market is actually very, very smart. So they actually give the eventually most of the time they give the right valuation which the business deserves. And if you're having a division that is very fast growing, but it is a very tiny percentage of your overall business, the stock market will not reward you with a very high P multiple right away. If they demerge that particular business and listed as a separate entity, then that particular business will get a very high value, much more higher valuation multiple.
All right. So, do you think new age startups and changing dynamics of new age businesses give good hope and stability for staying with the business? I mean, the reliability. Do you trust new age businesses nowadays?
I think by the time most of these new age businesses are listed, 1.5 2 years ago, most of they listed at absolutely obnoxious evaluations, and there was not much left on the table for the public investor. And that's why that's why you saw many of these stocks down 70% in some cases. I think it's again reinforced a long held lesson that always pay valuations, profits, and cash flows and balance sheet above all else. We saw the same story playing out in 98, 99 during the dot-com bubble. Same thing took place 2 years back when you had people touting a technology super cycle and people are talking about new markets valuation. But eventually, same cycles keep repeating. We just need to be disciplined and have just be an ardent student of history to avoid such kind of investment in the stock market. Just have to be disciplined. There's no getting around it.
Right. So there is one from Saurabh. He's asking, I heard of your comprehensive framework of reviewing the companies. How do you initiate action on selling the companies based on negative reports basis your filter?
Negative reports. There was a very good article published by Marshall Investment Analyst and Ambit as well a few years ago on the history of Asian Paints, for example. And now the stock of Asian Paints has experienced many 20% declines in between in its journey because of short-term concerns. But eventually, the stock went on to create huge long-term wealth for the investor. I think no business goes on a straight line. This much I've understood over the last 15 years. Every business goes through some headwinds in the short run. Look at DV's Labs, for example, today. Look at Loris Labs, for example, today. These are not stock recommendations, but just to explain that even a well-managed business sometimes goes through short-term headwinds. And you have sharp corrections. Look at Tata Elxsi, for example. Stock is down a large extent points because growth rate started decelerating. So every business will go ups and downs, but that's the journey of most big multibaggers. It'll not be a straight line up. You have to be patient, and you can really make life-changing wealth from the stock market only by holding on to these good companies through the ups and downs, not just the ups. You have to hold them through the downs as well and keep adding on declines. And eventually, over the long run, you end up making good money.
Right. So, if we ask a straight question, what is the magic formula for a multi-bagger or so as to make money in the market?
The magic formula for a multi-bagger is basically when you get a situation of what is known as variant perception, which is one of the framework we have followed at level partners. So, what does variant perception means? Variant perception refers to situations where you get return on capital employed ROC expansion coupled with earnings growth that leads to valuation re-rating, and you end up with multi-baggers. So basically, when you have a
Gautam, sorry to interrupt in between. People are reporting some voice issues. So, can you please once again check with the connection or so?
sure, 1 second. Is my voice coming better now?
At times it is better. In between, it's breaking also.
Okay, just 1 second. Hold on.
It's more like a glitch from Twitter
Prince, is
Spaces
my
and only.
now?
Yeah, much better, much better. I think he got disconnected. He'll connect again. So, guys, in the meantime, if you're liking our work, please check out our handles and do give us a follow so that the future spaces you can access easily. And if you have any positive, negative feedback or any suggestions for future spaces as well, so please feel free to DM me, or you can tag me over a tweet, or you can also reach out over my email also. So please feel free. And if anybody of you wants to ask questions as a speaker, please send in a request.
Prince Bhai, Gautam has joined again. Maybe you can make him a speaker now.
Yeah, he's there. Yeah, it's better, sir. So same question, if you can repeat from beginning, sir. Yeah.
Sure. So the one of the most effective ways to find multi-baggers in the stock market is to invest in situations with variant perception, which refers to situations where you get ROC expansion with earnings growth and valuation re-rating, and you get multi-bagger returns. So variant perception comes from having a differentiated view on the short to medium term trajectory of a business, and there are various triggers for variant perception. Number one, product mix change into a higher margin category. Number two, operating leverage, which may come from having high unutilized capacity at the beginning of an industry upcycle. Number three, industry cycle shift. So, since middle of 2020, we have had a revival of the residential real estate cycle in India, and we have had many multi-baggers coming from the building material space since then. Number four, regulatory change. So, since early 2020, after the government of India gave a heavy emphasis on ethanol blending, we saw many multi-baggers from the sugar mills and distillery space. The next source for variant perception is deleveraging. So, if debt goes down, then debt, which is a capital portion of your capital employed goes down, your return on capital employed basically goes up. Also, as debt goes down, interest cost goes down, net profit goes up, market cap goes up. The next source for variant perception is improvement in asset turns. So you can get this information from managements on the conference calls. You can ask them what is the expected turnover on the new fixed asset capacity, and between improvement in fixed asset turnover and margin improvement, which are the drivers for ROC expansion, I prefer improvement in asset turns because high margins tend to attract competition. Finally, we have corporate actions like demergers, reverse mergers, promoter management.
I think we again
Divestiture of a non-core
lost
business.
you. So, Ravi and Kanan, are you able to hear?
No, I'm not able to hear.
So, Gautam sir, if you
Is the
can hear
voice
us,
not coming,
please.
Prince, right now?
Yeah, right now it's coming. It got dropped some 10-20 seconds ago.
Sure. Like demergers, reverse mergers, promoter management change, and divestiture of loss-making business or divestiture of a non-core business. All of these lead to ROC expansion, and coupled with earnings growth, you get valuation rating, and you can get multi-bagger returns in all these situations. So, multiple ways to make money in the stock market. Find one that suits your temperament and personality and circle of competence, and invest accordingly.
Yeah, Kanan, you can quickly ask your question.
Yeah. So, Gautam sir, what is your view around SME investing? Like, how should one approach? Because I won't say it in as many words, but there are promoters who are, there's no media coverage in the first place around those promoters, and then we know for a reason that there are some promoters who list their companies just to convert their money from one source to another, and there's some lucrative value opportunities available over there, available at because they list at a P of just 8 to 10. So how do we navigate around those companies, and is it a good area to look at, or we should look at mature businesses
No,
only?
I think we should not overlook any area of the stock market. I think there are many opportunities or areas in the stock market to make money. So we should not disregard SMEs as an opportunity. In fact, even in my personal portfolio, also I have exposure to one SME company. But again, you have to have a very strong local network of based on which can do basically do the scuttlebutt for you, or which you have some deep local knowledge on the promoters, because understanding the promoter quality is very, very important in these SME stocks. Some of these promoters, actually the kind of outrageous guidances they issue, it clearly tells me that they are looking for market cap rather than focusing on building the underlying business. So very important to read between the lines and observe what the management is talking about in their annual reports and other public communications.
Got it.
Right.
Thank you.
So there is one question from talkative investor. He's asking, glad that you spoke about upward averaging. What is one of the most crucial aspect which you consider to average up the business in your portfolio? Is it the management commentary, improving financials, FII increasing their stakes, or anything else?
Simple. If the management is, suppose the management guided for 20% growth and they're actually showing 30-40% growth, then that is exceptional execution. And what happens in such cases is, on such high earnings growth delivery, the stock price actually becomes cheaper on a trailing basis. So that is the situation in which I'm very happy to average upwards. You have to keep a track of valuations at all times. And in such cases, the valuations incrementally keep becoming cheaper with great execution.
Right. So Ulavesh is asking, when an AMC sells mutual fund business to another AMC, how it affects performance previous and post transfer?
I'm not sure about the answer to that question. I'll have to skip that one.
Okay, so how come we differentiate the sudden spike is really due to change in fundamentals like increase earnings, margins versus order book announcement and any other announcement? Which kind of above two will sustain for long run, and which kind of stocks we need to look for?
Not actually too clear about the question. You're talking about the sudden spikes in volume or the margins?
Uh, Change in the fundamentals actually. He's talking about increase in earnings, margins, and order book announcement and etc.
Yes. So basically, see so we have to check whether the increase in margins are sustainable, or is it due to a short-term supply disruption. For example, a lot of these commodity chemical companies which are currently benefiting from the China plus, the lockdown in China, we have to understand that this is a temporary tailwind, because these commodity chemicals at the end of the day are just that, they're commodities. So once China restarts production, then the margins will revert back to mean, and that is when you'll get permanent loss of capital in many cases if you overstay your welcome. So very important to understand whether the tailwinds are long term in nature or just temporary in nature. That's basically how you differentiate in such situations.
Right. So there is one from Ravi. He's asking about large FMCG companies. So are they worth investing at current valuations, or view on the sector basically?
So I think, in my view, I'm very clear. So India is a growth market. I don't want to really invest in a 70p multiple companies showing 10% growth, but I'm happy to pay 60-70p multiples in select cases for companies which can promise me 25-30% earnings growth for the next 4-5 years. So if at all you want to pay high valuations in India for any consumer company, pay only for the ones which are showing you very high growth and which have a large, unorganized market to capture market share from. I think, you want to have long runway for growth and very high, potential for revenue growth as well. But do not pay exorbitant P multiple for 10% earnings growth companies. I think that's not really how wealth is created. It may help you. It may help you preserve wealth, but won't really help you in creating big wealth.
So, Gautam, you talked about like looking for consolidated profit pool and focus on the supply side dominance. So, would you like to talk about that?
Yes. So the key to investing success is not to see how fast an industry is going to grow. What matters for sustainable long-term wealth creation is whether you can identify consolidated profit pools within the value chain of an individual industry and look for players which are having supply side dominance or dominant market share. Because what happens is with each passing crisis, which happens every few years, these dominant players keep getting stronger and stronger at the expense of their weaker competitors. You ideally want to look for an industry in which one particular player is dominant and this competition is basically either weak or dumb or inefficient. That's basically how you get very big wealth creation over time as these industries converge into more of a monopoly or an oligopolistic structure from a fragmented one.
Right. So, Ravi, if you can speak now, you had some issues. Have any question, or shall I move on to next?
We move on
So,
to next.
Gautam, how good? Yeah, how good we are on time, Gautam?
We can go for another 3-4 minutes.
Okay, great. So, one last question, like, who are your investing idols, to name a few?
Well, there are so many of them. So you have Chuck Akre of Akre Capital Management. You have Terry Smith of Fundsmith UK. You have Joel Greenblatt, who previously ran Gotham Capital, and he was a very big proponent of special situation investing. We all know about the greats: Warren Buffett, Charlie Munger, Phil Fisher, Peter Lynch, Howard Marks, and there's so much to learn from all of these people. I think, for example, in case of Peter Lynch, he gave a simple concept that if the earnings go up over the long run, so the stock prices will follow. If the earnings fall, then the stock prices will accordingly follow downwards as well. Simple, right? Warren Buffett and Charlie Munger, have basically they are like an encyclopedia of investing. And Warren Buffett, in his early days of running the Buffett partnership, practiced a variety of investing styles like special situations, deep value, then cheaply valued stocks emerging from bankruptcy. He tried, and the portfolio turnover during those initial 12 years of running his hedge fund was as high as 400%. So the buy and hold, which we talk about from Warren Buffett today, that Warren Buffett is practicing that on a very large base of capital today. But in his initial days of running other people's money, he used to focus on maximizing post-tax returns, even at the um action of having a very high portfolio turnover. So different investing styles based on different investing circumstances. Howard Marks has written an excellent book on understanding market cycles and positioning our portfolio for long-term success. That book is titled Mastering the Market Cycle. It's a very good read. I highly recommend it to all investors. Phil Fisher taught the importance of focusing on high quality businesses with strong competitive advantages and holding on to them for the long run and not really diversifying too much into average or mediocre quality businesses. Charlie Munger, has taught us a lot about the importance of patience and having a very strong, sound temperament. And Chuck Akre and Terry Smith of Fundsmith, both of them have talked a lot about emphasizing on quality of business and quality of management. So many things to learn from all these different investing grades. I think the key is to keep learning and keep evolving along the way in our journey. That's the most important. You have to be a learning machine in order to succeed in this business. And to outperform the rest, you have to outlearn the rest in this particular business. You have to be very passionate about the mental process of investing.
Right, fair enough. So, Ravi, you had raised your hand. Any question you can quickly ask?
Just one thing on white goods sector. We since you were bullish on manufacturing and it gives a perfect blend of manufacturing and long-term India's growth story. So white goods or consumer durables, how you see those sector and white goods have come down dramatically because of margin pressure. So any view there?
Very, very bullish. I think the best way to play this is through EMS, electronics manufacturing sourcing. And the EMS industry in India itself is projected to grow at 20-25% over the next 5 years. When when an industry is growing at 20-25%, if you can find the most efficient, strong players in that industry, you can make really good money over the next 4-5 years. That's the way I'm playing it.
Right. So, Gautam, there
Understood.
is one question from Krishna Prasad. He's asking, what are some of the best ways to hedge one's portfolio against near-term volatility? Because it's not wise to churn for portfolio all the times, but also it is difficult to keep quiet during volatility. Any hedging ideas?
Well, I've never tried to hedge my portfolio against near-term volatility because stock price just randomly fluctuate on either side every day, sometimes for no reason at all. So I'm not really sure of a way to hedge volatility in terms of the erratic movement of stock prices. They just keep going up and down. And if you want to minimize volatility, the only way to do that is to invest in a fixed deposit, which keeps going up every single day. But stocks by nature will fluctuate every single day. So you have to just accept that as a routine feature of stocks.
All right. So one last question, Gautam. Like you talked about, you look for companies who are declaring big capex or they are about to complete. Like because so initially, if they are declaring the capex that is yet to complete, or maybe the nature of the capex, whether it's a new expansion or just a maintenance capex. So how we should look about the capex thing? And I read in the capital returns books like the 2-3 years which follow the big capex announcement are basically low earnings and low margin years. So any view on that front?
Yes. So let me answer the second part of your question first about the capital returns part. So when a large number of players are on big capexes within the same industry at the same time, that is what leads to dilution of returns on capital and margins down the line. But if it's a monopolistic industry or an oligopolistic industry, in such cases, generally the expansions are a bit more measured, and you don't really get that collapse of the margins and the return ratios in those cases. So, and also, if you invest in such companies before the capex actually goes on stream, generally many of the stock market participants wait for the capex to get commercialized and then they initiate their positions. But if you buy it a few quarters ahead of such commercialization, you can actually enter at a much more reasonable valuation because most of the market participants do not want to wait for do not want to handle the uncertainty of the capex going on stream. But then again, the valuations ultimately will dictate the risk and rewards in such cases. So you have to decide whether you want certainty at a higher valuation or you're comfortable embracing uncertainty at a cheaper valuation.
Great, great. So thank you so much, Gautam, for agreeing to our request initially and coming today for such a insightful session. And I have read the book. It's a very, very great book, and all the chapters are just too much of learning. So I highly recommend all the participants, if they have not read the book already, they can surely have a look at the book, and surely they will gain a lot out of it. So anything you want to say in concluding remarks, Gautam, or anything you or I missed asking you, maybe you want to say in.
I would simply say believe in the power of India and its entrepreneurs and its businesses. Markets will go up, markets will go down, markets will go up, markets will go down, and stocks will go up 10, 20, 30, 40, 50x along the way. So just focus on the individual businesses and stay the course. That's the most important. For example, we know that over the next few months, we may have a turbulent phase in the market where, because of some crisis in Europe or some financial market, some financial market action in America. So, we may get a short-term sell-off, but these things just keep coming and going like clockwork in the stock market. Just stay the course for the long run and benefit from the long-term growth story of India. That's it.
Great, great. We can reckon we should be long on India. So thank you again. And guys, if you are liking our spaces and the interaction with great minds in the industry, please do check out our handles, and you will surely get a lot of insight from the people we are inviting. So thank you for keeping for so long, and thank you once again, Gautam sir, for your time. And surely we'll like to have another session sometime down the line. So Ravi, you want to say anything?
No, just want to thank Gautam. Great listening to you. Yeah, thanks.
Thank you.
Thank you. Thank
And
you.
the session was recorded, and the recording will be available on my handle. And additionally, I'll be putting the audio on my YouTube channel as well. So those who missed and had experienced any glitches, they can surely listen to the glitch-free session again. Yeah. Thank you. The session is purely educational. So whenever you are like asking any questions, please make sure you should not ask any stock specific questions. And in the meantime, during the discussion, if any names would be taken for discussion or illustrations, those are by any means not a buy sell recommendation. Please take today's session as a starting point and do your own due diligence. Don't act on the names taken during the conversation. Yeah, thank you.